All right, let's talk about corporations, and then we'll hopefully be able to wrap on time. If there's a spectrum, corporations are at one end and partnerships are on the other. A partnership is a flat structure, one person, one vote, equal rights. A corporation is really the opposite. You only get what you put in. Shareholders have no management rights at all except for voting for directors. We're going to be talking, of course, about corporations extensively throughout the rest of this course, so I'm just introducing them here to give you a perspective. So here's sort of my little handy chart of the differences, just to show you how different they are. On the left, my right, we have a partnership, and on the right we have a corporation. And we're talking about rights of partners versus rights of shareholders. Partners, as a default, have a right to participate in daily management, everyday decisions, major decisions. Shareholders have no rights to do that. Only to vote for directors. They don't have any say in what the corporation does on a day-to-day basis. In general partnership, every partner has unlimited liability for all the corporation's debts and torts. In a corporation, all the shareholders have only limited liability. They can only lose what they invested, no more than that. In return for that liability, partners of a general partnership have agency authority. If you are a partner, that is showing to the world that you have authority to bind a partnership. If you're a shareholder, that shows the world you have no rights to bind a partnership. Shareholders cannot, I'm a shareholder of Microsoft. I can't make them enter into a contract. Right? So that becomes obvious when you think about it. Whereas if you're a partner in a law firm, you can make a contract with Xerox for that copier. I wish we had a contract for a new copier. Wouldn't know. Whatever. I'm glad it can duplex. That's all I can say. And tax liability. So tax liability is going to drive a lot of these decisions. Partners have a tax liability directly. The entity is sort of a little more intertwined with them. The tax liability flows directly to the person. Whereas in a corporation, you're a shareholder, you only get a tax hit if you sell your shares and have a capital gains, or if there's a dividend distribution and you get cash in your hand. And so they're really different in that way. Oh, and by the way, what corporation am I highlighting here? What corporation's headquarters is this? I thought I heard it. Apple, yeah. This is Apple's new $6 billion headquarters. Yeah, the mothership, the spaceship. There's solar panels around the whole thing, by the way, which is pretty cool. All right. How do you form a corporation? You file a document. That's true of everything except what? What are the we learned about one, really. There's another one. It's not even really a major entity. Two types of entities you don't have to file. Sole proprietorship, general partnership. Don't have to file. Everything else you have to file. Corporations you have to file. You file with the Secretary of State. You have to include the corporate name. And interestingly, the number of authorized shares. We're going to come back to that. We're going to look at that in critical detail as we deal with formation. And the name and address of the incorporator. So we'll look at that as well. The articles can also state things like corporate purpose and other regulations, and you can limit the power of the company, but you rarely do. This is all going to be covered in 2 weeks. How is a corporation governed? Centralized management, not a flat structure. Partnerships are flat. Everyone, one person, one vote. That's the default. Not the case in corporations. Corporations are one share, one vote. You have to pay for those shares. And all you can do with those shares is appoint directors, and the directors run the company, not the shareholders. The legal authority to manage a corporation's business is vested in a board of directors, which is elected by the shareholders. So very major decisions go through the board. The board, however, usually appoints like an officer, a CEO, a CFO, a COO, other executive officers who they serve at the pleasure of the board. They can be hired and fired by the board. Again, not by the shareholders. The board has to do that. But those officers do have authority to make corporate decisions. And we'll see a couple cases where the president of a company outstepped his authority. And we'll see how that played out. In MTI Dage. All right, so how are the board members elected? Usually by a plurality of vote. We talked already about cumulative voting versus straight voting. There are different voting techniques, so you can remember that. How about financial rights? This also is easy, thankfully. It's really easy. It's pro rata. You get a share of the profits based on your number of shares in the company. 100 shares, you have one. They make a distribution, you get 1% of that. There's 1 million shares, you have 10,000, you get 1%. Right? It depends on your percentage, your pro rata share of the shares. And you're only paid if the directors declare a dividend. Are you liable? No liability for shareholders, with the exception of piercing the corporate veil. And as we see, that will only happen for very small corporations where you have 1, 2, maybe 3 shareholders. By the time you get to a corporation with 5 shareholders, you almost never see veil piercing. But generally, the rule is that shareholders have limited liability, with the exception of that doctrine that we will learn. But that is the exception. Again, it's a very highly tested doctrine, even though it rarely happens in practice. But for the rest of this course, we're going to make sure we cover everything you need to know for the Pennsylvania bar. So we will be talking for 2 weeks next semester about piercing the corporate veil. But don't get your mind too wrapped up about it. It doesn't happen very often. It's really a rare thing, just something to test on in corporations. Can you transfer your shares? Well, if you look at your book says corporate shares are freely transferable. While that's true on a technical level, that's not really true on a practical level. I mean, for one thing, if you're the stockholder in a small company, no one might want to buy your shares. I mean, in order to transfer your shares, someone has to want to buy them. In order to sell them, you need anytime you want to sell something, you need someone to buy it. So the general rule is that shareholders are free to transfer their stock without the consent of the corporation. That's the default. But they have a broad right to sell to other investors, but that doesn't mean anybody wants those shares. Whether you can sell your shares and how much you get for them is going to be contingent on the market. And so that's a limitation. Market conditions limit transferability of shares. Also, securities law restricts transfer of shares. Shares in a corporation are a security, and securities laws apply to sale, original sale, and resale. So we're not going to learn about the security laws in this class. I hope we can talk about them in other classes. They are complex and interesting, obviously beyond the scope here, but they provide transfer restrictions as well. And so federal law can thereby restrict transfer. And in addition, corporations can limit. The default is that there's free transferability, but a corporation can put in their bylaws that the board of directors has to consent to transfer, can put that in the certificate of incorporation. Shareholders can even agree among themselves privately. If Mary Beth and I are shareholders in a company, I can write a contract with Mary Beth that we mutually agree not to transfer our shares without the other's consent. We can write that document. We can have that contract. So while corporate shares are the most transferable about any of the entities we talked about, the idea that they're freely transferable is a little much, because there are all these ways that there are these transfer restrictions that pop up in other areas of law. How long does a corporation last? Forever. I mean, unless it fails. But usually they don't have an expiration date, and since they are separate from the people that founded them, person dies, those shares get inherited. Corporation rolls on. They're selling your shares does not cause a dissolution or anything like that. So a corporation, we say, has perpetual existence. Doesn't mean it will last forever. Corporations fail every day, but technically they have lives that are independent of their owners. They can be dissolved. You have to file a document, but unlike a partnership, if you dissolve the company, you can't force a dissolution. A shareholder can't. A small shareholder cannot force a company to dissolve, just like they can't force a company to do anything. Right? If you're a shareholder, all you can do is appoint the directors. You might be a 99% shareholder, but aside from voting for the directors, you cannot force that company to dissolve. If you're a 99% shareholder, you should be able to appoint directors who will abide by your wishes to dissolve the company. But technically, shareholders cannot force a corporation to dissolve. Nor do they need to. They have limited liability. They can sell those shares. They can exit in other ways. They can't force a cash out like a partnership. So in a way, you're a little more stuck. And they can merge. Mergers and acquisitions of corporations is a huge topic. It's complicated, and it's a subject of an entire module. You have to file a certificate of merger, so it is more complicated. And in addition, there's quite a lot of law pertaining to mergers and acquisitions. We're not going to deal with that here. But know that corporations can merge, but there are some definite complexities to it that you don't have in a partnership. You do have to make that a public filing.